Okay, so let's do some questions on reg second unit. Okay, let's start. First question is, a corporation purchased AC Corporation purchased a new laptop computer for $3,000 for use in the taxpayer's business. What is the maker's recovery period for the computer? So for computer, what should be the recovering period you take in maker's depreciation? 10, 10 years, 6 years, 5 years, 3 years. So what should be the right answer?
6 years.
Computer, are you sure? For computers, automobiles, and farm equipment, we take the 5 years of 5 years recovery period. Okay, 10 years is usually for transportation vehicles, and 6 year is not the classification under maker's recovery period, and 3 year is for special tools. Okay,
Okay.
so laptop computers are considered a 5 year property. Also automobiles also have 5 year recovery period. Next question. Winkler, a CPA, provided accounting services to a client, Thompson. On December 15 of the same year, Thompson gave Winkler 100 share of Foster Corporation as a compensation for services. So, in, in terms of compensation, he gave the 100 share of Foster Corporation as a compensation for the services. The adjusted basis was $4,000 and the fair market value at the time of transfer was $5,000. 2 months later, Winkler sold the stock on February 15 for 7,500. So what is the amount? What is the amount? Yes. What what is the amount that Winkler should recognize as gain on the sale of stock?
2,500.
Yes, correct. Since you are receiving it for your services, so it will be recognized at fair market value. And when you sold it, yes. So $5,000 was the stock basis earlier, and he sold it for 7,500. So he have a $2,500 of gain on this transaction. Next question. A corporation stock price. Our corporation stock price has been rising to $750 per share. In order to lower the market price to a more affordable amount, the corporation executed a 3-for-1 stock split. Which of the following statement regarding each shareholder basis is correct? So the stock price has been rises to $750 per share. So in order to lower the market price, the corporation executed 3-for-1 stock split. So you have to tell if the stock split happen, what should be the new basis?
Option D.
The total basis and the per share basis will both decrease. No.
The total basis will remain same. Per share will undergo change.
Yes. That means answer number D should not be the right answer because it says it will be decreased. Per share basis also not remain same. Total basis and per share basis both will not increase. Option
Option
number A
A.
is the correct. Okay. Next question. Xylo, a calendar year C corporation, acquired the assets of X, also a calendar year C corporation, on March 11 of current year. One of the asset acquired was a trademark to which Xylo properly allocated 1,200,000 of purchase price. So, what is the amortization deduction for the current year? So, he has acquired the asset, and when he acquired the asset, one of the asset was trademark. So, you have to tell what should be the amortization amount for the trademark. So you are getting this asset as a part of acquisition. So what should be the method, or what should be the time? How much time you can amortize it?
15 years, 1 5.
F- what are you saying?
1 5 years, 15 years.
No. Yes, yes. Okay. 15 years. Yes.
Correct.
180
Hmm.
months.
Hmm.
Yes, right answer. So, since you have acquired this asset as a part of acquisition, that means it will be qualified under Section 197 intangible asset, which is amortized over 180 months. So, calculate the amortization for the current year.
It's option D, 80,000.
Okay, yes. 80,000. Just a minute, I am calculating.
12 lakh divided by 15.
But it is acquired on March 1.
Proportionate I have to calculate.
Yes.
It's option B, 66,667.
Yes, correct. So, it will give you science. Okay. Next question. A taxpayer report the following capital gain and losses. So he has short-term capital loss of 3,000, short-term capital gain of $1,000, long-term capital loss is $2,000, and long-term capital gain is $5,000. So what is the amount and character of taxpayer's net gain?
$1,000 long term.
Okay. So first you will net off these. It will give you net
Achha, it's a loss,
thousand
2,000.
dollar loss. Okay, then you have to net off this. It will give you $3,000 gain. So since they will come with opposite signs, then short term can be offset against long term. That will give you $1,000 long term gain. So correct answer three. Sorry. Okay. So next question is, Ellen owns 100 shares of a Prime Corporation, a publicly traded company, which Ellen's purchased on January 1, year 1 for $10,000. On January 1, year 3, Prime declared a 2-for-1 stock split when the fair market value was $120 per share. Immediately following the split, the fair market value was $62 per share. On February 1, year 3, Allen had his broker specifically sell the 100 share of Prime stock received in the split when the fair market value was $65 per share. So, what amount should Allen recognize as a long term capital gain? So, he has 100 share which he have purchased for $10,000 in year 1. In year 3, a 2-for-1 stock split happened when fair market value was $120.
It's B 2000.
Okay, how you are calculated this amount?
It's cost of 100 minus fair market value at the time of split stock 120. So 20 into 100.
Okay, he's selling at the fair market value of $65 per share. So, have you considered this value?
No, but that would be a washout sale, na? January 1st to February 1st.
No, no. On January 1, no sale is happening. It only declare a stock split.
Then in that case, you have to consider fair market value at the time of split stock 62, which was sold to 65.
Since it is a stock split, you do not recognize any gain and loss on the stock split. That means your basis again will remain same $10,000, but it will be split into
200.
now 200 shares. Okay, so that
Hmm.
means for 200 for 200 share you have your stock basis of $10,000. That means for each share your stock basis will be 10,000 divided by 200. It will give you 550. Yes. So $50 is the per share basis, and now you are selling it for $65 per share. So you are selling your 100 share for $65. So that means 65 is the selling price and your basis is 50. It will give you $15 of gain on each share. And this is for 100 shares. That means you have total gain of 1500. Is it clear or any doubt?
No, it's clear.
Okay, so it will be a long term or a short term gain?
It's a long term, more than 12 months.
Yes. Okay, next question. A taxpayer purchased 5 acres of land for $20,000 and placed in service other depreciable personal property that cost $100,000. So, disregarding business income limitation, what amount of cost recovery can the taxpayer claim this year? So since it is a business use asset, so what kind of various cost recovery methods you can use, or how much you cost you can recover in this year?
1,20,000.
Okay, are you sure?
Mm.
Hmm. Okay. So since we have various cost recovery method, first is we can claim section 179 expense. Next we can claim bonus depreciation, and then we can claim the maker's depreciation. Okay. Since section 179 expenses, bonus depreciation and maker's depreciation is not applicable on the real property which is land. Okay. So land, section 179 and bonus depreciation are not applicable for real property. That means land is will be not qualified for 179 and bonus depreciation. Also, we do not calculate any depreciation on land. Thus, it will not also qualified for maker's depreciation. So that means this cost we can't claim in our 1040. But talking about personal property, for the personal property we can claim 179 deduction as well as bonus depreciation as well as maker's depreciation. So $100,000, since this limit is less than the limit given for section 179 expense, so that means whole this amount can be claimed during the current year. Okay. So any doubt in this question?
No, understood.
Okay. Next question. With regard to depreciation computation under general maker depreciation, the half year convention provided that. What is the meaning of half year convention?
It's a half year depreciation.
Yes, for the year in which the property is placed into services. So what should be the right answer?
Option A,
But there is no as such condition that you have to place in services before June 30. By default you use half year convention, but if your for more than 40% of asset are placed into services in last quarter, then you use the mid quarter convention. So A is not the right answer. So the right answer will be
option C.
yes, correct. Option number C. So half year convention means you will take the one half of the year's depreciation in which the property is placed in services. Okay, same half year depreciation is taken for the year in which property is disposed of. Next question. Dove Corporation began operating a hardware store in current year after constructing a building at a total cost of $100,000 on land previously acquired for $50,000. In the current year, the land had a fair market value of 60,000, and Dove pay real estate taxes of $5,000 in the current year. So what should be the total depreciable basis of the business property? So he began operating a hardware store after constructing a building. So cost of building is given, cost of land is given, and real estate taxes is given. So what should be the depreciable basis?
It's 155.
It's
155.
okay. So please consider this land is not depreciable asset. Also, real estate taxes will not add to the
Pertains to land.
depreciable
It
basis.
pertains to land. Then only building will be a
Yes,
cost
the
1 lakh.
only building will be depreciable. Okay,
Yes.
clear? Okay, next question. GEM Corporation purchased all the asset of a sole proprietorship, including the following intangible asset. So, federal income tax purposes, what amount of these intangibles should be amortized over the specific statutory cost recovery period? So, you are acquiring these assets as a part of acquisition.
What do you mean that this covenant not to compete?
Sorry,
What do you mean by the second line of item?
covenant not to compete. So, covenant means this is the condition that if you are acquiring this asset of this sole proprietorship, then there is a there may be some covenant, that means some promises, some obligation that the party should not be engaged in similar profession or trademark for this specific period or within the defined geographical area. Covenant means terms and conditions. So if you are acquiring the asset of other company, there may be some condition associated with it. This condition is not to compete, means do not involve in the same business within some geographic area. You do not have to operate this business. Okay. So these both are intangible assets. So you have to tell what should be the amount which we need to amortize.
It's the 50,000. Only goodwill will be amortized.
It's 50 or 63. So it will be your $63,000. Okay. So for the tax purposes, we also amortize our goodwill. So if you
Yeah,
add,
it's T63.
yes. Okay, next question. Which of the following is a capital asset? Capital asset.
C land held as investment.
Yes. So capital assets are those assets which you held for investment or you are using for the personal purposes. Okay. Inventory, account receivable, or any asset you are putting into the business, they will be classified under non-capital asset. Okay. Next question is under the maker's depreciation. For the property placed in services after 1986. Okay. So this is actually just a statement that is needed to complete. So under the maker's depreciation, if you have placed your property in services after 1986, then what should be the like correct condition?
It's either B or C.
It's B. Okay, salvage value is ignored for purposes of computing the maker's deduction. So we do not consider the salvage value when we calculate the depreciation according to maker's method. Okay. Next question is Baker's Corporation, a calendar year C corporation realized taxable income of $36,000 from its regular business operation. In addition, the Baker had following capital gain and losses. Baker did not realize any other capital gain and losses. What is the total taxable income for the current year? So, please note this is given for a C corporation, not an individual. Okay, so answer accordingly. So he has taxable income of $36,000, short-term capital gain, short-term capital loss, long-term capital gain, long-term capital loss.
It's B 47,500.
Okay, let's calculate. Short-term capital gain will be offset against short-term capital losses, so it will give you net gain of $4,500. Okay, so it will give you net gain of $4,500. Next, long term is offset against long term capital losses, so it will give you net loss of $2,000. Okay, since short term and long term are both with opposite sign, then you can offset against each other. It will give you net 2,500 of gain. So this gain will be taxable with your taxable income. So net taxable income will be $36,000 plus 2,500. So it will give you $38,500, $38,500.
No, but in that case, the computation between individual and C corporation is same, no?
No, no. Yes, in
If
this case it will be same. But if you have net losses here, then you for individual you can offset up to $3,000 of losses against other income. Okay.
okay,
But in
well,
C
I
corporation, net losses do not offset against other income. Since it is a case of net gain, it will be same for individual and corporation.
okay.
Okay. So where is your mistake?
So I thought of this 2000, which is a long term had a cannot be set off and it will be carried forward against future income.
Your voice is breaking.
The 2000 long-term capital loss, I thought of it would not be settled or it will be carried forward.
Okay, okay, okay. No, if they are having opposite sign, then they can be offset against each other.
Okay, got it.
Next question. A taxpayer purchased an option to buy 1,000 shares for $200 per share. The taxpayer purchased the option for 50,000, which was to remain in effect for 6 months. The market declined, and the taxpayer let the option lapse on August 1. The taxpayer would report which of the following as a capital losses for the year one income tax return. So, okay, just a hint for this question. If you are holding an option to buy some share, it will be considered as your capital asset. So you purchase the option for 50,000, but you do not use this option, and option will lapse on August 1. You have to tell what will be your capital loss in this case.
It's 50,000 short term.
Yes, correct. So since it is a capital asset, you will have capital loss of $50,000. Next question. A C corporation has following capital gain and losses for year one and year two. If the C corporation had no capital gain or losses prior to year one, what is the minimum net capital gain that is reported for year two? So year one capital gains are given, capital losses are given, and year two capital gain and losses are given.
It's A25.
Yes. Okay, you will offset this capital uh, gain and losses against each other and get get net $50,000 of loss. So this capital loss you can carry forward to next year and carry back also. But since you do not have any capital gain in prior to year one, that means you can only carry forward this loss of $50,000. For year two, are having you are having the capital gain of $75,000. So carry forward losses can be offset against this income, and you will left with $25,000 of capital gain. Okay. Next question. Alice gifted stock to her son Bob in year 5. Alice brought the stock in year 1 for $8,300. The value of stock on the date of gift was $6,400. Bob sold the stock in year 7 for $15,800. You have to tell what should be the Bob's recognized gain and losses in year 7. So Alice has gifted to Bob. Alice's stock basis was 8,300, whereas the market value on the date of gift was $6,400, and Bob sold it for $15,800. So please remember, how will you calculate the stock basis if you have gifted some stock?
It's option C.
$15,800 of gain.
It's a gift, or you may consider as a fair value. In case of fair value, it will be 9,400.
Since when you gift some shares or when you receive something in gift, some shares in gift, then the basis will be carryover basis. Uh, okay, generally this is the rule. But in case if you have fair market value less than your carryover basis, then your stock basis will be calculated when you sold this asset. So please remember, uh, I explained you about the dual basis rule. So you have to arrange your fair market value, adjusted basis, and sale price of stock in increasing or decreasing order. Then whichever value is coming in between, you have to take this value to calculate your gain or loss amount. Have you calculated according to this or something else?
Not according to this. Then it will be
Oh,
15,800 minus the middle value will be 8,300.
yes, your fair market value is 6,400. Then your adjusted basis is 83, and your selling price is 15,800. So middle value, that means you will take the adjusted basis. So $15,800 minus your 8,300. So it will give you $7,500 of gain. Okay. Any doubt?
No, no, got it.
Okay, next question. Alpha Corporation purchased and placed in services $100,000 of computer equipment on January 1 and dispose of the computer on March 31st of year 3. No other depreciable asset were placed in services in year 1. Alpha uses maker depreciation to recover the cost of the asset and rate for property with the 5-year recovery period and 7-year recovery period are given. So you have to calculate the depreciation for the year 1. Okay, so it is a computer. So which category will you choose, 5-year or 7-year for computer? Recovery period should be 5-year or 7-year?
5 years.
5 years, yes. It is placed in services on March 31st. So that means, sorry, in on January 1, year 1. Not the last quarter. That means by default you will use the half year convention. You have to calculate your depreciation for the year 1. Rates are already given. For year 1, 20% will be your depreciable rate, and your value of the computer is $100,000. So how much depreciation will it give you?
20,000.
20,000. Yes. Correct answer will be $20,000. Okay, next question. Rick purchased 100 share of XYZ stock on April 4, year 4 for $8,600. He sold 50 share on February 8, year 5 for $3,000. He then bought another 50 shares on March 1, year 5 for $3,200. So how much loss will it recognize in year 5? So he has some stock which he purchased on year 4 for $8,600. So 100 share he has purchased for $8,600. Then he sold 50 shares. sold 50 shares for $3,000, and then again buy back the 50 shares for $3,200. So you have to tell what amount of gain you will recognize in year 5. So consider the date February 8 he is selling, and then on March 1st he is buying back.
Wash out.
Yes.
It's D0.
Are you sure?
Whatever loss, it will be adjusted against the cost of shares which you are buying.
So you are adjusting all the loss because he has like 100 share, he is selling only 50 and buying back the 50 shares. Okay. Yes, he's selling 50 and also buying back the 50 share. That means all the 50 share he's selling or buying is a wash sale. So yes, correct answer will be D, 0. So you will not recognize any losses. Okay. So you have here $1,300 of loss here. Okay, if you consider for 50 share, it your stock basis will be 4,300, and then you are selling it for 5,000, 3,000. You will have $1,300 of loss. This loss will not be allowed. Instead, add to the shares of new stock. So 3,200, you will add this $1,300 of loss in the stock basis of this 50 shares. Okay. So this is based on your wash sale. Any doubt in this question?
No.
Okay, next question. A descendant's estate included 100 shares of stock in a publicly traded company, originally at a cost of $10 per share. The valuation of the at the date of death on January 15 was $100 per share. The stock was distributed to estate sole beneficiary on March 31st, and beneficiary immediately sold the stock for $110 per share. What is the amount and character of gain? You have to tell. So, uh, you are receiving it on behalf of some descendant. That means it is a case of inheritance. So, valuation on the date of death was $100 per share. Then the stock was distributed on March 1st, and beneficiary sold it for $110. So, what is the amount of gain and losses and nature? So, in case of inheritance, will you take this purchase cost, fair market value, or other something other?
It will be fair market value and original acquisition will be considered for the short term and long term.
No. In case of inheritance, your holding period will always be long term, no matter when you are acquired it, when you have purchased it. Okay. But for the valuation, you will take the fair market value on the date of death. But if you have chosen the alternate valuation method, then it will be lower of your earlier of your 6 months after the death or the date of distribution. Okay, you will take the fair market value, whichever is earlier. So since they have not elected any alternate valuation method, so it will be your fair market value on the date of death. So $100 will be the per share basis, and he has sold it for 110. It means $10 is the gain he is getting on each share. So he has 100 share, 100 multiplied by 10, it will give you $1,000, and it always remain the capital gain in case of inheritance. Okay, it will always be long term in case of inheritance. Any doubt?
No.
Okay. Next question. A married couple abandoned their principal residence in May. They had purchased the house 5 years ago for $350,000. The house had a current fair market value of $300,000. So, what is the maximum loss they are allowed to deduct in their current year tax return for abandoned
Mm,
property? So, they are selling their principal residence. You have to tell any loss on personal property will be allowed. If allowed, how much it will be allowed.
it will be zero.
Yes. So any losses on personal properties disallowed. Okay. So it will be $0. Okay. Any doubt in these questions?
No, Ganesh.
Oh, okay. Then we will discuss next unit in the next class. Okay. That is unit 3, C corporation, S corporations.
Okay, then.
Okay. I am sharing the PDF in the group.
Yep. Thank you. Bye bye.
Okay. Bye.